Okay, thank you very much again, dear students, dear colleagues. That's my pleasure to be here today. I would like to thank Professor Grigoriadis for this possibility to deliver lecture on the central bank digital currencies topical issues to the audience of Freie Universität Berlin. Evharisto, Theodore, Theohari. Let's start with our agenda for the lecture today. It must be on your displays, so please let me know whether you see the presentation. Is everything okay? Okay, it must be okay. So we are going to have a quick view to a new but fast developing story of central bank digital currencies. Then we will turn to the nature and definition of central bank digital currency. In this part of our lecture, we'll try to distinguish between central bank digital currency and traditional non-cash or cashless electronic money, and between central bank digital currency and well-known cryptocurrencies like Bitcoin, Ether, Litecoin, Dogecoin, etc. So after that, we will move to the case of possible scenarios and designs, that is constructions and way of issue of central bank digital currencies. And we will have a look at pros and cons, or key advantages and major risks for adopting central bank digital currencies. Through all these points of agenda, we are going to take an overview of the Bank of Russia's approach to a digital ruble. So that is our plan for today. However, before we start to explore central bank digital currencies, we have to define some specific terms that are quite frequently used in a digital day life. So these terms are distributed ledger technology, or DLT in short, cryptocurrencies, tokens or crypto tokens, and stable coins. So we will use these terms today as well. Let's start with distributed ledger technology. Sweden's central bank, the Riksbank, provide us with the following comprehensible and I think it's quite understandable explanation of using distributed ledger technology for crypto assets. Many crypto assets use so-called blockchain technology, where each transaction is signed and recorded in a ledger as a chain of transactions. Generally, this is done by a network of computers or devices. So these devices are called nodes that all have a copy of the ledger. That's why we call this technology distributed ledger technology. Because yes, and generally, as I've already said, all these computers, all these devices have a replicated copy of information, and due to the fact that there are so many numerous identical copies of the information replicated in these nodes, these crypto assets and cryptocurrencies are very difficult or even impossible to counterfeit. So this is one of the major attractive feature known for cryptocurrencies. And another quite interesting and quite popular feature known for
how that use the tele
is anonymity. Anonymity for the holder of assets.
Igor, I would like to request Mrs. Nirenberg, can you please take off your microphone, because, and this holds for everybody. If you don't want to ask a question, please take off your microphone like all of us. Thank you.
Okay. So that is in short about distributed ledger technology. It's quite popular technology, quite known technology due to crypto assets and especially cryptocurrencies like Bitcoin and other examples of cryptocurrencies. Now we can move to the definition of cryptocurrencies. What is cryptocurrencies? Well, as defined by the Central Bank of Russia, cryptocurrencies are decentralized virtual currencies based on a mathematical algorithms and protected by cryptography methods operating in a decentralized payment system or payment system based on just described distributed ledger technologies. Cryptocurrencies like Bitcoin, Ether, the most widespread cryptocurrencies in the world, and altcoins, that is other cryptocurrencies other than Bitcoin and Ether, are crypto assets that are not backed by any physical asset. So it's quite important to stress that cryptocurrencies are not backed by any physical assets. As a result, they cannot be redeemed by the issuer. But still, they are intended to be used as a means of payment. Now, a couple of words about token or crypto token. According to Merriam-Webster dictionary, in general, a token is a piece resembling a coin issued for use by a particular group of specified terms. In a digital world, a token is a unit of account designed to present a digital balance in some asset, for example, crypto assets we just discussed. According to the Central Bank of Russia, a token is a unit of account in the blockchain network used to present a digital balance in a particular asset or to account for interchangeable digital assets. So tokens are usually used to create derivatives based on distributed ledgers. In other words, a digital token or a crypto token is a unit of cryptocurrency. Digital tokens are acting as an accounting entities in distributed ledgers. It is like substitute for securities in a digital world, or substitute of vouchers or coins in the digital world. And one more term we have to specify, that is stable coins. So you can see on the screens that stable coin or stable coin is the name of a group of crypto assets designed to follow the value of another asset. The issuer will hold an amount of initial asset in a reserve, like for example, an amount of euro, and only after that it can issue a proportional amount of stable coins. So unlike cryptocurrencies like Bitcoin and Ether, stable coins are always backed by proper amount of a reserve asset held by the issuer. So that is key terms that we are going to use today during our lecture. I hope this short explanation will make it more or less clear about the nature and definition of these terms. Now we can start to explore central bank digital currencies topic. As I have already mentioned, central bank currencies or CBDCs in short is a quite new but very fast developing story. In November 2015, just a little bit more than 6 years ago, the Committee of Payments and Market Infrastructure, that is a special designed working group within the Bank for International Settlements, so-called the Bank for Central Banks based in Basel. So this special committee issued a report called Digital Currency. This report provided an overview of the key features of digital currencies and recommended that central banks continue monitoring and analyzing the implications of both developments in digital currencies and distributed ledger technology. So that is a direct quote from this report called Digital Currencies. 2 years later, that is in March 2018, less than 4 years ago, the same Committee on Payments and Market Infrastructures, in collaboration with another department of the Bank for International Settlements, prepared and published the joint report named Central Bank Digital Currencies. Actually, this report introduced the wide and general use of the term central bank digital currencies and provided an initial analysis on central bank digital currencies. In a foreword to this milestone report, authors noted that analysis of two committees reflected, that is, quotes from this report, initial thinking in this rapidly evolving area, and it is a starting point for further discussions and research of CBDCs. So let me stress that
Igor,
it was less than 4 years ago. Yes.
May I interrupt you here? Because I mean, what you're saying is super interesting, but I think the students could have, and in general, I think it's a very logical question. So when you're talking about digital currency, you're talking about currency that does not have a paper or a metal form, right? A currency that is only traded, because we have I mean, we are also using credit cards, right? I mean, one could
Yes.
ask.
Yes.
So what is the difference in the end of the day? We also have nowadays in this traditional currency world, digital measures to spend faster and receive money faster. What is the added value of this digital step? I mean, I think maybe to explain to all of us intuitively what that is.
Okay, then we will have to move a little bit forward.
No, don't move. I mean, I don't want to disrupt the structure. I just want a quick answer so that we can follow you better as you proceed.
Actually, we have a special slide with the definitions of central bank digital currencies. So, as I have already mentioned, central bank digital currencies, this term was introduced just in March 2018. That was in this milestone report published by the Bank for International Settlements. But to be honest, the term central bank digital currency is not universally defined so far. Each central bank traditionally started report or survey on central bank digital currencies with the definition of its own digital currency. So I've got examples of 3 definitions. That is definition of digital yuan, that is a digital currency of the People's Bank of China. So short remarks from the report of the People's Bank of China. Digital yuan is a digital version of fiat currency issued by the People's Bank of China. So digital yuan has all the basic functions of money. That is same as physical form of yuan. And digital yuan is China's legal tender. So digital yuan, ECNY in short, is a central bank's liability for public. That is definition of digital yuan. Let's move to the definition of digital euro, for example, provided by the European Central Bank. European Central Bank is quite short about the term digital euro. So this term is introduced in report on digital euro published by European Central Bank in October 2020. So the term digital euro, as you can see on your screens, the term digital euro denotes a liability of European system, the ECB and national central banks, recorded in digital form as a complement to cash and central deposits. And just one more definition of central bank digital currency, that is digital ruble, definition introduced by the Bank of Russia. Digital ruble will represent a digital form of the national currency and will have all the necessary properties to perform the functions of money. It will be issued by the Bank of Russia. A digital ruble will be an additional form of money and will circulate along with cash and non-cash ruble. So digital rubles will be, again, the liabilities of the Bank of Russia. So I hope from those definitions we can summarize three major facts about central bank digital currencies. So the first fact, central bank digital currency is a digital form of national currency or regional currency, like in case of digital euro. And this central bank digital currency will circulate along with cash and non-cash forms of national or regional currency. So this is the third form of national money. Second important point about central bank digital currency. It performs all the functions of money. And third, that is the key element, that is direct liability of the central bank. So let me maybe move to the question that is quite frequently asked by the audience. That is the question about the differences, or question about distinction between central bank digital currency and traditional non-cash electronic money we are using in our daily life. But just before and to answer this question, we have to return to the three major functions of money that are described in conventional economics. So what are the three major functions of money? That is medium of exchange. That means that money plays an important function, can be used in exchange of goods and services. The second major functions, the unit of account, so money acts as a common standard for measuring the value of goods and services. And the third major function is store of value, meaning that money retains its worth over time. Well, according to these major functions, virtually any assets in nowadays economic system can play the function of money. No wonder then during the history of mankind there were different types of money, and we can mention I think four of money. Different types of money throughout the history of mankind. That is commodity money. Actually, commodity money is the simplest and that is the oldest form of money. It was closely related to barter system, where goods and services were exchanged directly to each other. And commodity money just facilitated this process because commodity money acted as a generally accepted medium of exchange. So examples of commodity money are shown on your screens. There is gold coins, silver coins, beads, shells, could be spices, pelts, etc. So the critical thing to note about commodity money is that its value is defined by the intrinsic value of the commodity itself. So for example, polar fox pelt has its intrinsic value because it could be used as a warm winter clothes during the winters, and not only in winters, and it may also act as a medium of exchange. But today, in nowadays economic system, we use fiat money. So fiat money is quite different from commodity money, because fiat money gets its value from a government order. The Latin word fiat meaning is let it be done. It means in the sense it is used in the sense of order or decree or resolution. So that means that government declares fiat money to be legal tender, which requires all people, individuals, households, businesses, companies, legal entities, banks, and other financial and non-financial entities within the country have to accept fiat money as a means of payment. If individuals and entities fail to access legal tender, to accept legal tender as a means of payment, then they may be fined or even put in a prison. So, unlike commodity money, fiat money is not backed by any physical and commodity or physical assets. And it's quite an important fact that all modern economies are based on fiat money system. And examples of this fiat money include state-issued coins and banknotes. But another important note for our understanding of fiat money and digital central bank digital currency we are going to discuss. In any economy, central bank is responsible and eligible for issue of national currency that is declared to be legal tender. So that means those coins and banknotes, state-issued coins and banknotes, are really issued by central banks that are eligible and responsible for issue of national currency. There is also fiduciary money. Fiduciary money depends for its value on the confidence that will be generally accepted as a medium of exchange. So, Latin word fiducia, trust. Unlike fiat money, fiduciary money is not declared legal tender by the government, which means people are not required by law to accept fiduciary money as a means of payment. Instead, the private issuer of fiduciary money promises to exchange it back for a commodity, or fiat money, if requested by the holder of fiduciary money. As long as people or legal entities like companies and banks are confident that this promise will not be broken, they can use fiduciary money just like regular fiat or commodity money. Examples of fiduciary money include checks like old school American Express travels checks or Thomas Cook travels checks, drafts, bills of lading, private banknotes, like for example Disney dollars issued by the Walt Disney Company and redeemable for goods and services at many Disney facilities. Quite important note that fiduciary money is private money. It's not declared to be legal tender by government, and fiduciary money is also evolving as technologies advance. So it becomes electronic and digital as well. And those cryptocurrencies actually are examples of modern form of private fiduciary money. And let me say some words about commercial bank money, or sometimes this type of money is called also credit money, because it's quite important for understanding the distinction between a central bank digital currency and non-cash electronic money we are using in our daily life. So what is commercial bank money? Actually, commercial bank money can be described as claims against private financial institutions, namely commercial banks, that can be used to purchase goods, services, or assets. In other words, commercial bank money is debt generated by commercial banks. So that is liability of commercial banks that can be either exchanged for fiat cash money issued by central banks. If you receive, for example, cash at ATM or in bank's cash office, or these liabilities of commercial banks can be used to buy goods and services. If you use cashless payment instruments like debit or credit cards provided by commercial banks, or by using, for example, bank transfers from account to account. That is all forms of non-cash electronic money. You may ask me why using commercial bank money is in essence an exchange of private commercial banks' liabilities. It's quite simple, because when a person or a company or any other legal entity opens bank account and puts some cash fiat money onto this account, that is legal tender coins and banknotes, in this process, they create bank's liability, that is commercial bank's debt to depositor. So, turning back to central bank digital currencies, we can make the following important statement. CBDC is different from cash, as it comes in a digital form unlike physical coins and banknotes. So CBDC is a digital form of money. At the same time, CBDC is similar to cash because, the first fact, CBDC is issued by central bank like fiat cash money, like coins and banknotes. And the second key point, while cash money is issued in the form of banknotes with unique identifiers, so you know each banknote has its unique number and series number, a CBDC like, for example, digital ruble will be represented as unique digital codes stored in a special purpose electronic wallets. So, due to this fact, the Central Bank of Russia, for example, refers a central bank digital currency as digital cash. So, because this form of money will be represented as a unique digital codes stored in a special purpose electronic wallets. So that is about similarities and differences of future central bank digital currencies and cash. Now about differences and similarities of CBDC with other form of non-cash payment instruments. As I have already mentioned, CBDC is different from existing forms of cashless payments instrument for consumers, such as numerous non-cash electronic money, credit transfers, debit cards or credit cards or e-money, because a CBDC represents a direct claim on a central bank. So that is a liability of central bank. Like in case of commercial bank money, we were talking about liability of private banks. CBDC is a direct liability of central bank. Second difference, that is difference of CBDC from cryptocurrencies, such as Bitcoin, Ether, or Litecoin, or other private digital tokens, like stable coins, for example. Cryptocurrencies are digital private fiduciary money. They are not declared to be legal tender. Actually, in some economies, in some countries, private digital currencies, cryptocurrencies are prohibited. For example, China. CBDC is going to be a digital fiat form declared by government to be legal tender. So that is the difference from private cryptocurrencies. But it's quite interesting moment regarding the CBDC. CBDC might be similar to private cryptocurrencies by technology used for CBDC issue. And in this case, regarding the technology that could be used to issue central bank digital currencies, we have to make one more side step and to distinguish between two basic technologies that are typically used in money issue. That is token technology and account-based technology. So a key distinction between token, some examples, yeah. First of all, token-based money are cash and cryptocurrencies, while account-based money, examples of account-based money, is balances in reserve accounts, that is accounts of commercial banks open in central banks, and most forms of commercial bank money, that is accounts opened with commercial banks by either individuals or businesses like companies, legal entities. So key distinctions between token and account-based money is the form of verification needed when money is exchanged. Token-based money and token-based payment system rely critically on the ability of payment receiver to verify the validity of the payment object. In other words, money itself. So when you receive, for example, a 100 euro banknote, the first thing you are doing, you are checking whether that is original 100 euro. So that is the question of verification of the money itself or verification of the payment object. Quite the same story is with the digital currencies, tokenized digital currencies. In the digital world, the worry is whether the token or digital coin is genuine or not. There is concern about electronic counterfeiting and whether it has already been spent or not. By contrast, in systems based on account money, depend fundamentally on the ability to verify the identity of account holder. So the key concern in this case, in case of account-based money, is identity theft, which allows criminals or hackers to transfer or withdraw money from accounts like bank accounts or even loyal card accounts where you get your, for example, cashback under the customer loyal program. So the key concern is the situation when criminals or hackers transfer, withdraw money from your accounts of your colleagues without permission of account holder. That is unauthorized access to accounts. So that is the key distinguishes between token-based and account-based money. Returning to the central bank digital currencies. theoretically and technically, central bank digital currencies could be both account and token-based currency. If central bank use a token-based technology for CBDC, then this CBDC is qualified as cryptocurrency. In this case, a CBDC could attribute all features of private cryptocurrencies. The most important and the most well-known are anonymity and difficulty to counterfeit. Because of this digital decentralized, distributed ledger technology used as a basis for CBDC platform. But in this case, there is a question, quite serious question. I mean, in case of token-based CBDC, this is the issue regarding the search of a balance between the anonymity of central bank digital currency holder, and on the one hand, and concern of society relating to misuse this form of money, namely money laundering, financing of terrorism, and using other unlawful financial operations. Technically, it's quite important fact, technically a token-based CBDC can be designed to provide different degrees of anonymity, similar to private cryptocurrencies. And that is one of the major points about the future application of central bank digital currencies. If central bank is choosing a token-based central bank digital currency, so one of the questions the central bank has to resolve is the question of regarding the degree of anonymity, because on the other hand, there are concerns related to money misuse or the use of money in different unlawful financial operations. At the same time, according to, for example, the Bank for International Settlements, most central banks are considering at the moment various technical infrastructure, but current proofs of concept trends basically are based on distributed ledger technology. That means that the platform, CBDC platform central banks are going to use is gonna be based on distributed ledger technologies, but access frameworks to central bank digital currencies tend to be used on account identification. So that means that future central bank digital currencies, from the point of view of major central banks, will be like nowadays commercial bank accounts or wallets, where holder of this wallet personal data of the holder is to be identified. And for example, the People's Bank of China and the Bank of Russia, both central banks unanimously identify both future digital yuan and digital ruble as account-based CBDCs. While, for example, the European Central Bank is investigating both token and account-based options for a digital euro. But at this current stage, European Central Bank is one or even two steps behind its Chinese and Russian colleagues. And now another key point on CBDC's route, that is the way of accessing a CBDC for different participants of an economic system. So if the central bank digital currency is intended to be a digital form for use by the general public, like households and businesses, companies, non-financial organizations, then this form or this type of CBDC is traditionally referred to as general purpose or retail CBDC. In contrast to retail CBDC, a wholesale CBDC is designed for restricted access by financial institutions only. In other words, a wholesale CBDC is similar to today's central bank reserve and settlement accounts, that is, accounts of domestic commercial banks open in a native central bank. While retail CBDC could be described as a digital equivalent of cash with a wide access for general public, and retail CBDC offers a new option for general public for holding and using money. And I want to explain the latter statement regarding new option to the general public for holding and using money. What I meant. As you probably know, traditionally central banks have, for various reasons, tend to limit access to traditional non-cash account-based central bank money to banks only. That means that those accounts opened in central bank are available only for commercial banks, not for individuals or companies. By contrast, physical central bank money like coins and banknotes, that is cash, is widely accessible for all, for both banks and households, individuals, and companies. But as you know, or as you probably know, in some economies, the use of cash is decreasing promptly. For example, since 2016 to 2020, the share of cashless payments for goods and services in the retail trade, catering, paid retail services in Russia increased significantly from 39 to almost 70%. Therefore, Russians are already actively using cashless payments. Same story, as you can see, can be observed in the United Kingdom, Switzerland, France, also Scandinavian and Benelux countries. So there is a situation, well, central bank cash money is disappearing from circulation in these countries. Access to the traditional non-cash central bank money for households and businesses is still restricted. As a result, general public, like individuals, households, and businesses, they can only rely nowadays on commercial bank money or private digital money if the latter is not prohibited by law in the country. In other words, the forthcoming possibility to use possibility of complete cash use disappearance implies that general public will no longer have wide access to central bank money. So again, cash is disappearing, and central bank accounts are not available for general public. As a result, central bank in a couple of years would be no longer accessible for general public. I think that is one of the key facts or the major driver why in the surveys and studies central banks focus primarily on retail CBDC system, as it involves significant innovations with respect to the existing forms of money, and that is direct quotation from, for example, the Bank of Russia report on digital ruble. So the new retail central bank digital currency system can better meet customer needs and contribute to the development of the digital economy. While wholesale CBDC system imply the improvement of the payment system that is already existing between financial institutions. And now the money flower, this Venn diagram that is presented on your screens illustrates the 4 key properties of money, that is issuer, central bank or not, form of issue, that is digital or physical, accessibility, widely accessible or restricted, and technology is used, that is account-based money or token-based. In other words, that is centralized or decentralized settlements. And this money flower, well, initially, by the way, it was presented in the working paper published in 2017 by Beck and Garrett. The name of this working paper was Central Bank Cryptocurrencies, not Central Bank Digital Currencies. And this diagram is often considered in the discussion on CBDCs. So it reflects the correlation between the existing forms of money and digital currencies, as well as other liquid financial assets. And you can see that central bank digital currencies, the gray shaded area, is located at the intersection of the digital asset petal, that is gray petal. Sorry, to move back. So central bank digital currencies, the gray shaded area is located at the intersection of digital assets petal with the petal issued by the central bank, and the red petal that is open access. And also by yellow petal, the yellow petal that is token-based, decentralized circulation petal. So that is regarding central bank digital currency nature, definition, distinctions and similarities to traditional or canonical money forms. And now, if you don't mind, let me move to the ways or models, or as frequently also called designs of central bank digital currencies, implementation to financial system. In this part of our lecture, we'll use 4 models described by the described by the Central Bank of Russia. So in all models presented, the creation and operation of the central bank digital currency platform, as well as the issuance of central bank digital currency, that is digital ruble, is initiated by the and performed by the central bank. And let's have a look at the first model. Central Bank of Russia called this type of model Model A. According to the Model A central bank opens wallets for banks for interbank settlements only. So that is a typical wholesale central bank digital currency system. So this diagram describes the wholesale central bank digital system, because access to central bank digital currency will be granted only for financial institution. I have already mentioned that from the very beginning, that is the date of publication of a digital ruble report by the Central Bank of Russia in October 2020. So from that date, the Bank of Russia declared that it didn't intend to further develop this model, as this type of a model didn't offer additional benefits to households and businesses compared to the existing payment system. In other words, that is one of possible design model for CBDC, but not applicable for Russia, Russian financial system from the Bank of Russia point of view. But still, for example, European Central Bank can apply this type of model if European Central Bank decide in the future to imply a wholesale CBDC model to in Eurozone. The second model, second possible model, Model B, I like it most. This Model B could be described as a central bank opens and maintains customer wallets on CBDC platform, and central bank issue a central bank digital currency for households, for individuals, and companies, legal entities. Central bank will settle payments using the wallets that are going to be open for end users, that is customers. So according to this model, the central banks creates a central bank digital currency platform, issue a digital currency, central bank digital currency, and provide direct access for individuals and legal entities to special design wallets. These wallets are used then for settlements between individuals and companies. And it's quite important, I'd say, keynotes for this type of a model. All these settlements are provided by the central bank without any involvement of banks or any other financial intermediaries. Model C, the third model. That is a model where central bank can open and maintain customer wallets on a CBDC platform, while banks and other financial intermediaries act as intermediaries and initiate the opening of customer wallets and payments using them. So in this model, individuals and companies possess direct access to the wallets opened and serviced by the central bank. But there is also a place for banks and financial intermediaries. So, for example, they will have to provide mobile applications for access of general public to their wallet accounts. Actually, commercial banks and other financial intermediaries will receive requests to open wallets for CBDCs, and banks will transmit this request to central banks. And there is another quite important function for banks in this model. There is special checkup procedures in relation to clients. That is like anti-money laundering, combating financing terrorism, proliferation of weapons of mass destructions procedures. So all these procedures will be entitled to central banks. As a result, the function of banks will transform to, let's say, technical functions. And now a couple of words about the fourth possible model, that is model D. It's quite similar to the model of intermediation that banks play today in financial system. So we can see that it looks like model C, but the key difference is that in model D, central bank will open wallets, CBDC wallets for commercial banks and financial intermediaries that will get access to the CBDC platform. And banks and financial intermediaries will open CBDC wallets for clients. That is households, individuals, and companies. Let me move to this comparison table where all four models are presented. So that this model comparison by function of central banks and financial intermediaries. Just to summarize, we can see that wholesale model A, as I've already mentioned, most central banks consider that model A didn't offer additional benefits for households and businesses compared to the existing payment model, existing payment systems. As a result, major central banks are not intended to develop this possible model. Model B, with no place for commercial banks intermediation, that is a real threat for the traditional banking system. What for do we need banks if model B is realized? We can see that central banks, by opening CBDC wallets directly to individuals and companies, by settling transactions through these wallets. Well, actually, these models, as I have already mentioned, has no place for commercial banks, and that is a real threat for the traditional banking system. Model C, the third model, assigns to commercial banks only minor technical functions that do not relate to money itself. So banks are to provide mobile application for wallet access, CBDC wallet access for customers like individuals and companies. In Model C, banks will be responsible for carrying out special checkup procedures related to clients. In Model C, banks will be responsible for forwarding the client's request to open a CBDC's wallet to the central bank. As I have already mentioned, there is quite limited technical function if we compare with the present financial and banking system. And Model D preserves the functionality and significance of commercial banks and economic system at the existing level. No wonder that according to the survey conducted by the Bank of Russia, for example, 84% of respondents were in support of this type of a model, that is the decentralized two-tier retail model. And the major opinion, this model is preferable since it preserves the existing model of interaction between financial institutions and their customers. So
Igor,
again,
I would like to ask you to close in 5 minutes your lecture.
Yes, I'm almost near the end of my presentation. And just a couple of words about advantages and possible risks connected with the implementation of central bank digital currencies. So let's start with the advantages. Of course, both potential advantages and disadvantages heavily depend on the implied design of particular CBDC, but still we can identify some general features. Among key advantages and opportunities created by CBDC are the following. The first one, that is introduction of innovative payment services. So we have already discussed that CBDC combines both the benefits of cash and non-cash money and will be available for wide use by general public, that is individuals and companies, as well as the state for payment purposes. CBDC will ensure the simplicity, high speed, and low cost, as well as high reliability and security of both online and offline payments. That means that national payment system is appearing to be more effective for end users again, individuals and businesses. And moreover, CBDC will improve the accessibility of payment services and digital financial instruments for general public. CBDC will enhance competition in the financial sector, diversifying both financial services and service providers, because banks and financial intermediaries will have to compete for customer funds, not only with each other, but also with the central bank and its CBDC, central bank digital currency, and lowering costs of payment as well as increasing speed of transaction will ultimately increase productivity and improve effectiveness of economic activity in general. And one more interesting fact about CBDC, actually CBDC in theory could secure intended use of funds. That could be quite helpful both in private and public social life. What does it mean? For example, parents are ready to support their child financially. They are ready to provide him or her with some money, but they want to be sure that this money will be spent properly on healthy food, not fast food, on a textbook for learning, not video games, or for sport activities, not for attending disco nightclubs. A CBDC can help parents to limit the future use of funds by their children for intended purpose only. Same story can be applied for social security payments by government, for example, or charity funds. However, there are a lot of challenges and risks attributed to CBDC implementation. Among them, technological risks, risk of insufficient performance of the distributed ledger technology, risk of difficulties in the implementation of confidentiality and protection solution, there is data privacy, proper protection, risk for token-based CBDC that we have already mentioned. There could be a problem for searching the balance between the degree of anonymity and concern related for unlawful financial operation and using misuse of money. And there is a risk and possible difficulties with the implementation of the offline mode for a CBDC, because most central banks has declared that central bank digital currencies, they all have to operate both in online and offline modes. So with offline modes, it's quite difficult at the current stage of technology. But there is another quite serious financial system risk. It is connected with the possibility of customers run out of commercial bank deposits through CBDC wallets. That means that application of CBDC could result in an abrupt change in the structure of financial system. Why customers can run out of bank deposits, and when this run out is possible? Because the CBDC, as a direct liability of central bank, will be free of insolvency risk, while bank deposits as liabilities of private commercial banks are not. So that is quite serious risk, systematic risk, and it's absolutely unpredictable and unmeasurable at the current state. And another possible challenge for CBDC implication, possible pure readiness of the infrastructure of trade and service enterprises, as well as commercial banks, and society's unwillingness to accept new form of money. Let me stop here. Haris.
Thank you very much, Igor. So let me now. So this is the end of the presentation, right?
Yes, I'm ready to answer the audience questions if there are.
Let us applaud you.
Thank you very much.